Some contract language can quietly transfer massive liability onto your business, sometimes more than your insurance can realistically cover. Today I'll show you the contract red flags, especially indemnity clauses, that can create uninsurable risk. Hi, I'm Marty with JMW Insurance Solutions. We help business owners protect what they've built, including spotting contract language that creates dangerous liability exposure before it becomes a problem. Contracts are not just paperwork. Contracts are risk transfer tools. They decide who is responsible when things go wrong, and in B2B, one of the biggest liability traps I see is the indemnity clause, especially when it's written broadly. Now, I'm not an attorney, and you should always use legal counsel for contract interpretation. But as an insurance professional, I can tell you this. Some indemnity language creates obligations that are difficult to insure, or that exceed the protection you think you have. Today, I want to explain what indemnity means in plain English, the red flags that should make you pause, why certain clauses can create uninsurable risk, and what a safer approach looks like. So what is an indemnity clause in plain English? It's essentially a promise that says, if something happens related to this work, you will protect us and pay for it. That can include legal defense costs, settlements, damages, and sometimes even costs beyond direct damages. Indemnity clauses are common in business contracts. The problem is when they go too far. Here's a simple framework for thinking about 3 levels of indemnity risk. The first level is the most reasonable. You're responsible for your own negligence. This says if your business causes damage, you're responsible for it. Most insurance structures are built around exactly that reality. The second level is broader. You're responsible for anything related to the project. This can pull your business into liability even when your fault is unclear or only partial. The third level is the most extreme. You're responsible even for the other party's negligence. This can require you to protect the other party even if they contributed to the loss or were primarily responsible for it. That is where you enter territory that is genuinely hard to insure and financially dangerous. Here are the specific red flags I want you to watch for. The first is indemnity language that says regardless of fault. If that phrase is in the clause, you're agreeing to protect the other party even if you didn't cause the loss. The second is any and all claims language. Broad language like any and all claims arising from the project can pull your business into liability for events you had no control over. The third is unlimited indemnity. If there's no cap or limit stated, you may be agreeing to potentially unlimited financial exposure. The fourth is contract requirements that exceed your actual insurance limits. Some contracts demand $2 million or $5 million in liability coverage, high umbrella limits, or special endorsements. If you sign without having those limits in place, you are exposed from the moment the ink dries. The fifth is when contracts combine additional insured requirements, primary and non-contributory wording, and waiver of subrogation all at once. These combinations are common in some industries, but they must all be properly supported in the policy. If they're not, coverage disputes can follow. The sixth is a broad duty to defend clause. Some contracts require you to defend the other party immediately, even before fault is determined. Defense costs alone can be enormous, and this obligation can kick in long before any settlement is reached. Here's why some of this creates what I'd call uninsurable risk. Insurance is designed to cover specific liabilities within specific policy terms. If a contract pushes your responsibility beyond those terms, you can end up paying significant costs out of pocket, even with insurance in place. And the danger isn't only claims, it's legal fees, project delays, disputes, reputational damage, and the kind of business strain that is hard to recover from. Here's the safer approach. Review the insurance requirements in any contract before you sign it, not after. Don't treat insurance as an afterthought to a deal you've already committed to. Make sure your coverage and endorsements are properly aligned with what the contract requires. If a contract requires additional insured status, confirm the endorsement is correct, not just noted on a COI. Don't assume you must accept every term as written. Many contracts are templates. Some terms are negotiable and it's worth asking. And for major projects or high-risk agreements, legal counsel can help you spot and revise language that could otherwise hurt you badly. Contracts can grow your business or quietly expose it. Indemnity clauses are one of the most significant risk levers in any B2B agreement. The best time to fix contract risk is before you sign, not after a claim is already in motion. If you'd like us to review your insurance limits and endorsements against your typical contracts so you know exactly where you're protected and where you're not, visit us at jminsuranceSolutions.com/businessinsurance